Hello and good afternoon. Welcome to Saxo's Q4 quarterly outlook call. We just launched it yesterday on our platform, on our websites, and it is titled Winter is Coming. Well, winter is not coming really in the literal sense in many parts of Asia, but still we have plenty of winter risks to consider. And we will be taking you through some of those on this call today. I'm Charu, I'm the market strategist with Saxo Singapore, and I'm joined today with my colleagues Redmond Wong from Hong Kong and Jessica Amir from Sydney. So just some house rules to take note of. There is a questions panel, I think, on the right side of your screens, and you can post the questions there, but we will take them at the end. And I think I'm going to just start off with a big disclaimer there. Everything that is shared here is for your general knowledge and information, and none of this is actually an investment recommendation. Just to take note of that before we really dig into what we are looking at into the fourth quarter. So this is broadly the agenda for the day. I'm going to kick off with our macro views, and then we're going to dig into some more details with our how those macro views play out in the different asset classes as well. Of course, the large part of what's been going on globally is the energy shock, which is of course stemming from the supply chain crisis and the geopolitical tensions that we've seen, and initially, of course, the inflation issue was really ignored by the central banks. But now with these energy costs accelerating, we did see in November last year a pivot by the central banks, and which is now kind of translating into some kind of stresses. So there's some stress in the financial markets, there's some stress in economic growth. So of course, more and more calls for recessions, which will likely be the big stories into Q4. And if when I start off with these macro views, I would see the winter coming in these four different aspects that I'm showing here on the slides. Certainly, the energy crisis, particularly in Europe, is the biggest concern. And the key question that we usually get is that will Europe really get through the winter? So with temperatures now dropping as the winter months are approaching and gas imports from Russia at a fraction of their former levels, the situation is tense. But I think the key thing here to consider is not what happens this year or next year, but overall, the energy costs are now consuming 14% of global GDP, which is up from 7% a year ago. So that's a big leap, and that kind of shows how much extra money is going in just paying your energy bills, which does kind of translate into a cost of living crisis in many parts of the world. And we will get to more details on that later on in the presentation as well. But if I'm being really, actionable here, what does a cost of living crisis mean? It means that it will hurt consumer discretionary, investments. So that's something to take note of. But secondly, when I talk about the European energy crisis, I think what are the solutions? And that's where your opportunities are as well. One, something that we've been saying for some time is that the solutions lie in a broad-based energy supply. So there will be some key reliance going back to our traditional sources of energy, oil, gas, coal, for example. But there will also be at the same time an acceleration in your green transition, which means there's a need to build that energy storage, that energy infrastructure. It would mean securing an end-to-end supply chain. For instance, in the electric vehicle space, where most of the minerals come from China. But so that means there's a heavy dependence on China. And given that we are in this more and more deglobalized world, you want to cut those vulnerabilities and build your own infrastructure solutions for that energy independence. And two, we need to invest in technological innovations that can give us some short-term solutions. For example, potentially artificial intelligence, which could bring some concrete and quick benefits to lower the consumption from, as soon as this winter onwards, because lowering demand is really the most important near-term solution that we have. Third possible solution, nuclear adoption. That's something, again, we'll get to later on in our slides. I also see some form of a winter coming in terms of geopolitics, where that in terms of the Russia-Ukraine conflict, Russia is losing a little bit of a military ground there, and with the ski winter season kicking in Europe now, I think this is the time when they will press harder the energy nerves, for Europe. Well, that could mean more and more threats of using nuclear. That does mean that could spur some risk off. And when you see geopolitics getting worse, you know what takes off, right? I mean, we've seen that in February, commodities. So think oil, think gas, think wheat, for example, and the likes. And that's where your risks are or opportunities are at the moment. The other key thing, of course, to take note of is the aggressive Fed tightening. We've been saying for quite some time now that the tightening by the Fed is potentially going to break something. So we are seeing things break slowly here and there. We've seen the Japanese yen break. We've seen the UK gilts market break. What is the next thing that could break? And when will the dollar peak or roll over, really? Well, that is, again, a key question, which we are looking to get some concrete direction on in the fourth quarter, where you could potentially see a temporary peak in the US dollar. But always, I think, remember that a turnaround in the US dollar is usually long and slow. And assuming if we do hit a recession, the market will be scrambling for liquidity. And liquidity is usually in US treasuries or the US dollar. So I think that's the third thing. And the fourth thing to consider here is an earnings winter, where we do see, again, some margin squeezes kind of happening because the costs are going up and the companies are unable to pass these costs on to consumers now, who are already having stretched budgets because of the high inflation. So of course, that's important to consider as well. I'll pause here and give the floor to my colleagues, Redmond and Jessica, to dig further into how these macro views are really playing out in the different asset classes. And I think we are going to start off with Redmond talking to us a little bit in more detail about what he's seeing in the treasury markets. We will let him have the floor now.
Hi, everyone. Thank you for coming to the call. And yes, and the Fed has quite successfully, since the Jackson Hole in August, to increase the degree of hawkishness, is the message delivered to the market, and increase the expectation of rate hike in the market. And I mean, it's the Fed fund rate, terminal rate, has been gone up to as one point, up to as much as 450 to 475%, and price in first quarter next year. And that has we think that is that we are the Fed will continue to sound very hawkish, but as Charu mentioned, during the process, it's going to break something, either the real economy or like the bond market, like what we saw in the gilts market, as Charu mentioned, and also the credit market. You have seen a little bit of it over the last 2 weeks, and until actually these last 2 days, it calmed down a bit, but it was quite a little bit of nervousness, especially last week in the credit market. And this has actually increased the chance that, and the notion the market start pricing in maybe the Fed or other central bank are close to slow down their rate hike. And so in the bond, and the 10-year Treasury was after the Jackson Hole, and it was once up to 4%, and then now back to 360 something. But it's a big jump before the Jackson Hole level, and we start seeing some value for investors in the bond market, especially in the high-graded bond. And because we think that we are close to the end of the tightening cycle, we're not so sure yet. And the Fed, be careful, of course, especially the Fed, will still continue to be sound very hawkish, at least in the next 2-3 months, until something is broken. But having said that, I think the market tend to see through it, and we start seeing some value with now a much better coupon than earlier this year. Earlier this year, bond market certainly did not do well, but because of the yield at that time was so low, it did not compensate for the rise in the inflation. But now with 5-year at 3.80 and in Treasury, and if you pick up some single A to double A investment grade bond, you can add another 80 to 110 basis points to it. So you will be getting close to 450 or even higher, close to above 450, and then get close to almost 5% in yield for single A or other, is a good credit. So, and at the moment, we don't want to touch the high yield, because we think that during this kind of process, and when the central banks do sound very hawkish, and that is not going to do well for the high yield, and also the economy is going to slow down or even running into a recession. That will also create some problem in the high yield space. And high yield is something for investors to look at maybe next year, but not now. And going to equity market, and we think that the equity market is facing two forces. One is when the market start pricing in central bank peak hawkishness, maybe the tightening cycle is end early next year, and that is supporting the stock market. I think you all have seen that over the last 2 days, when the stock market did a nice rally in the US and also today in Hong Kong. And when investors start pricing in, maybe the Fed and other central bank will not be, it's a follow through with as hawkish as they sound. And having said that, there are other forces, other headwinds in front of the equity market. Number one is the central bank like the Fed, and because headline inflation is still so high, even though the economy is coming down, they still need to sound hawkish. And until, as we said, we are still waiting for some event or something really being broken before they can actually shift the tune. Now they still have to sound very hawkish. They still continue to push back, and so it's a war between the market expectation of peak hawkishness and the Fed itself's rhetoric. So that will from time to time, that will still be some headwind for the stock market. And number two is, as we mentioned, if something is going to be broken, either the economy or the market or the bond market and in the emerging market, anything. We are not so sure which one, but but there will be some. But the casualties will. We are quite confident that is the Fed will continue until something like the credit market, if some more stress and so on. This will also add to the headwind to the stock market, and so provide a lot more volatility. And the third thing on this headwind for the stock market is really the earning. We have seen a bit of it in the second quarter in the earning announcement, and not so much about the earning themselves, but those for guidance. And now we are going into the third quarter earnings season, reporting season, and I think we need to be careful about maybe we will be hearing more for margin compression, problem on operating margins, outlook citing weak demand, and those will also trigger more analysts to revise down their 2022 full year earning forecast. and also revise down the 2023 earning forecast. And that will, of course, will be headwind for the stock market, and also will drag the stock market. So the market actually have two forces, different forces dragging it in two directions. And one thing for investors, we think that is for consumer discretion, because of the jump in the cost of living, and for consumer to trade down, and also to hitting their budget. And so consumer discretionary, we are expecting some problem on the margins and sales. So I think it's maybe better to stay away more from the consumer discretionary companies. But every time when there's a crisis, we emphasize, like over the last few months, we keep saying that every time when we have a crisis, we have some that will actually do some, a lot of time we drive innovation. And so we will be looking at some of those sectors which can protect the operating margin, can prove to be innovative, bring a new product or improve on the product, and especially in the real economy. On the slide, I saw one example is our equity head of equity, Peter Gani, and he showed this energy storage basket. This is just one example, and that will probably be one sector, one industry that will be seeing a lot more innovation and a lot of interest from investors, even before the overall market has become stabilized. And back to this part of the world, and similar case in China, when China is still a rather weak economy, the recovery is still not so certain. And even though despite all those stimulus, but one thing is very sure, that is the energy, as in our macro framework, energy globally, and is actually need a lot of investment, and China is going to spend a lot more in energy. The key thing I want to bring up here is that China is going to be emphasizing not just renewables, but also the traditional fossil fuel like oil and gas, and also coal. And because at the moment, coal still account for over 50% of China's primary energy consumption, it's unlikely that can come down. And so China will be investing a lot, actually still to continue in the coal industry, and especially in developing cleaner use of coal, and developing technology there. So there's a lot of opportunities there. And also in order to roll out EV and all the others, and the electric grid supply chain is going to receive a lot of investment and attention. That's also another area, and also battery materials, nuclear power, which later on my colleague Jessica will talk a little bit more about nuclear, and those will also be area of focus in the green transformation, and also overall infrastructure, especially energy infrastructure spending in China. And the last but not the least, and oil and gas will continue to receive investment and support from the government. And oil and gas production in China has come down, has peaked in 2015, and capex has not been catching up. And in fact, rely a lot in import. That is a concern. So that we'll be seeing a lot more investment in the oil and gas sector in China as well. That will present some investment opportunities for investors as well. I think from now, I pass it on to my colleague. Hi, Jessica.
Thank you, Redmond. So I hope everyone can see my screen. So very salient insights, as always, Redmond, and it flows perfectly to what we're covering here. So indeed, our house view has, I guess, has held in quite good stead, and that is we've been speaking about clients being overexposed to the energy sector, and what we're highlighting here is that the commodity sector has risen to the crop of or risen to the top in terms of the best performance across the equity baskets that we track at Saxo. And this is primarily from gains in the energy market. So Redmond spoke about ailing supply. It's not just in China, but it's globally. And indeed, over the past 2 days, if we reflect on what's been happening, this brings to light what we think might eventuate over this quarter and beyond into 2023. And that is one thing, and that is this one takeaway from the slide that I implore you to take note of, is that energy supply remains punitively short. OPEC Plus also see that there won't be enough supply to meet demand in 2023. So OPEC have said that on the record, and over the past 2 days, there's been speculation about OPEC Plus potentially cutting their production by 2 million barrels per day. This would be the most production cuts that we've seen since COVID-19. So this comes at a time when we have very short supply and demand rising. And we know the biggest consumer, as Redmond was alluding to, the biggest consumer of oil is, of course, China. So the thinking here is at Saxo that we'll continue to see upside in energy, and that supports the equity basket being commodities. And indeed, that goes back to where we've seen the most earnings growth. So as always, future earnings expectations impact how a market is performing and is indeed likely to perform over the coming horizon. So this quarter, also reflecting on what we've kind of said earlier, this quarter we've seen earnings be downgraded by the most in some time. So we've seen earnings expectations be slashed by 7%, and that's on the back of cripplingly high inflation and higher interest rates. And one of the central banks alluded to this yesterday, hint, hint, that was the Reserve Bank of Australia. So what does this mean? This is why always macroeconomic policy is really important. It basically vindicates that we are likely to see broadly across most sectors earnings to be squeezed, and that is going to dictate the lay of the land while we're in a higher rate cycle. So the most upside for the next 12 months, we think one of the key sectors will likely be energy. And if you look at the consensus as at today, consensus is that the energy sector will consecutively deliver the most cash flow, earnings and revenue growth potentially for the next 12 months on a rolling 12-month basis. So that's something to think about as well. Industrials, they're also potentially likely to do well. But indeed, we do have to point out the second best performer this year across our Saxo equity baskets is defence. And indeed, we heard from Biden overnight pledging more money be spent in the defence sector to send support to Ukraine. So bottom line takeaway here is earnings and cash flow growth drives share price growth. Think about these stocks and sectors that can continue to thrive in tighter liquidity while rates are rising. And if you just look at the performance here, you can see that the market is telling you that there's a very strong chance that while rates are hiking, commodities and defence are worth a look. The other thing that we're alluding to is the real world is running short of supply, and so real investment pretty much remains paper thin, which is more or less what we were speaking about before, and that is, make no mistake, really what's driving higher returns. But my real takeaway for you today, ladies and gentlemen, is to why look at the nuclear energy sector and why stocks in the sector are going nuclear. So for a lot of people, there's a misconception that perhaps that nuclear energy produces high emissions, but the facts are out, and it's actually a somewhat almost virtually zero emission technology. It's energy dense. So what does that mean? So one uranium pellet, as we can see at the top left, one uranium pellet, which is about 2.5 centimeters tall or 1 inch tall, that equates to about 2.8 million barrels of oil or 1 ton of coal. And how it's produced is very carbon neutral as well. In fact, zero emission. So what is driving this sector higher is that 10% of global energy needs currently come from the nuclear sector, but it's expected to play a very critical role in some economies going forward, because we know the world is running short of energy and will run short of energy, particularly in Europe in later 2022, and indeed in Europe and also in Australia in 2023. Notwithstanding that, the world is grappling with, a solution to paying cripplingly high prices for gas, oil and coal, with coal being at another record all-time high today. And also the world is searching for higher costs to renewable energy projects. It's also really worthwhile pointing out, ladies and gentlemen, that there is a global nuclear push, if you didn't know. So this is led by the United States, Canada, and Japan. And they're focusing on using nuclear energy as a primary energy source. So they have projects underway. They're taking submissions. And I guess the US is, of course, naturally leading the race. So just a few weeks ago, or in fact last month, we saw the Inflation Reduction Act come into play by President Biden. And then we had the US government award some contracts to some key companies in the sector, and we'll touch on those in a sec. But I guess the bottom line is, regardless of the traction, we know what's driving the uranium price higher at the minute is punitive supply and skyrocketing demand. So what we can see, and the bottom left is a graph of where we think, or not where we think, where the World Nuclear Association thinks that demand will rise to. So the thinking is that uranium supply will need to double by the end of 2040 to meet surging demand. If you also think about this sector, it's actually produced some of the world's best shareholder returns this year. So there's a little known company that you may know of. It's produced the second best return across the global share market, and also the second best return as well in the New York Stock Exchange. And that's a company called Constellation Energy. So they could be worth watching, because they're about to start hydrogen production this year powered by nuclear energy. And the US government, as well as the Canadian government and the Japanese government, are working on providing government grants to companies who can do this. So we'll say that again, providing hydrogen power powered by a nuclear power plant. And that is essentially to feed the grid. And so this is currently happening in New York. And so Constellation Energy shares are rising in anticipation of higher earnings growth to come. So Constellation Energy, their shares are up 112%. They don't make a fair chunk of their revenue from the space at the moment, but cast your eyes to the right-hand side of the screen. And at Saxo, we've put together a nuclear power theme. We've done some homework for you. So looking at companies across the globe that make the bulk of their revenue from nuclear energy. So you can head on to Saxo's platform to cast your eyes on the companies that might be worth a look. If you don't want to do that, if looking and doing research based on the inspiration here, if you indeed don't want to use Saxo's platform to get some helpful hints, why not check out the ETF URA? That's, I guess, more or less a proxy for the uranium sector. But speaking of proxies, I'll hand over to our one and only Charu.
Thank you, Jessica, and thank you, Redmond. I think we kind of understand now better why we are calling our quarterly outlook title that winter is coming. It is basically important to understand that it is a lot about the energy crisis and its fallouts, but more so it is about what solutions we are going to look at, to address this issue of energy crisis. Well, Asia, if I come closer to home, is not spared from that energy crisis either, especially because of its heavy dependence on LNG imports. And these LNG imports are actually very easy to divert because they go in tankers rather than pipelines. So with Europe being able to pay a higher price for LNG because of its energy shortages, it means that Asian supplies will get diverted to Europe now. Jessica has really covered, I think, Japan's nuclear push in a lot of detail. So I'm not going to cover that anymore. But what is also important to consider is in Japan and also more globally, the push in terms of renewables, the push in terms of net zero, the focus is now toward shifting towards net in the net zero equation. What does that mean? So you can produce all the carbon that you want, but you also develop technologies that capture the carbon back. So there are potential opportunities in these carbon capture technologies as well. I think Japan is really pushing a lot on that front. So I think that also goes to say why we remain overweight both our commodities baskets, which is a fair representation of the view that we're sharing here, that fossil fuels will continue to be the main source that meets the energy demands in the years to come, despite the shift towards renewables or this net zero push that we are seeing. So, commodities or our renewables baskets are not one or the other. They can both coexist in the current situation. The other countries in the region that may not have such a simple answer on nuclear. Of course, it requires a lot of investments, not just in developing that infrastructure, but also maintaining it. Some of those countries have a lot of fossil fuel reserves, and they will not naturally go back to that easy solution when you have a cost of living crisis and you're not able to meet the energy demands of your citizens. But meanwhile, at the same time, we are going to see this broad-based energy supply as the future, where, again, Jessica has discussed in detail about the potential for hydrogen, the potential for other technologies such as solar, wind, and the likes. And there are a lot of ETFs that kind of give you that exposure to, say, hydrogen in particular, where South Korea is leading the way globally as well. And lastly, I think important to consider also the smaller emerging markets, which are, of course, pressured a lot more because of this rise in energy costs and food costs as well. And we've seen a flavor of that crisis in Sri Lanka. A lot more countries are still exposed to it, say Pakistan, Bangladesh, Myanmar. Myanmar has actually started buying Russian oil and paying in rubles out of desperation as well. Now, this is just a reflection of the course that other emerging markets could take as well as they get immersed, knee deep in energy scarcity issues and stuff like that. So what that means is if more and more countries actually move to buying that Russian oil, it's a tail risk. I think we could see a shift in trade arrangements with Russia, and we could also potentially see a significant shift away from dollar-based financing in the region. So that obviously has some repercussions, not just for the global energy markets, but much beyond that in the financial markets as well. Well, this is the last slide we're going to share today, and that kind of just summarizes our key themes that we've shared over the course of this discussion. A lot of you are familiar with this Maslow's hierarchy of needs, and that's what I want to really highlight today. So it moves from physiological needs of food and clothing to safety and higher on from there, as you see in that picture. The needs lower down in the hierarchy need to be satisfied before individuals can move to needs higher up. And that's exactly the situation that we are facing in the financial world as well. We need to invest towards the bottom of the pyramid. So investments will likely go to ensuring everyone has a supply of food and energy for the consumer staples before we move higher to having robots help us to improve our lifestyles. In terms of in more actionable ideas, you have some down there on the slide, and I hope you can see that. But really, the next signal to watch now is when the dollar rolls over. Say the US 10-year treasury yields touching again 4%, a little bit higher than that, perhaps 4.2, 4.3%. And that's when the liquidity taps really open, financial conditions turn. And that's when you start to move, slowly from defensive strategies to more neutral strategies, I would say. Now, this is not really a timing call, but our key call in this quarterly outlook is that we are getting close to peak in interest rates because the markets can't take it any longer. So we are likely to see a pivot on the aggressiveness of the Fed, not really the Fed path in particular, which we still see there will be more tightening to come. So let's stop there. And we can take some questions we've got. You can still continue to post more questions if you have some. We already have a list here. Jessica, there's one for you. Do you want to take it? About investing into uranium via specific companies or via the ETF. Currently, the ETF is down 10%, and there's anti-nuclear segment sentiment. Would you be advising? Okay, we don't advise anything here, but I would let Jessica talk a little bit more on our call for nuclear.
Thank you very much for your question, and thank you, Charu. So yeah, great question about the proxy for the uranium sector, which is the URA ETF. So yeah, indeed, the uranium ETF is down 11.2%. But what we typically do with clients is if they do want to explore an ETF, it's really worthwhile. It only takes a little bit of time, but when you always do your due diligence before investing in anything, as you would with a stock, it's worthwhile to use Saxo's platform. Go and have a look at the fundamentals and the forward estimates for earnings and what have you. For an ETF, you can go and have a look at what makes up that ETF as well. So as in, what are the major stocks in that ETF? So if you do have a look at a lot of the stocks in that space, they have been hit by higher rates. So it's really key to remember that this is a basket of the biggest uranium ETFs across the globe. Of course, you can get outperformance, like you mentioned, Constellation Energy. So it's always best to typically think about when you are investing in a company that's got high rising cash flows and repeatable rising earnings, and that can typically can outperform an ETF. So if you are looking at that, again, encourage you to use Saxo's platform. After you go and get some ideas, perhaps from our nuclear theme or from the uranium ETF, go and have a look at the composition, then go back to Saxo's platform and then look at, is the company's earnings growing? Is its cash flow growing? It's really easy to do on the platform. All you need to do is just click on fundamentals. I hope that answers your question. Back to you, Charu.
Right. We also have a lot of questions on FX, and I do understand we've not talked about FX in particular, but as I highlighted, I think dollar topping out will be the key thing to watch for in terms of, in the fourth quarter, or at least in the early part of the first quarter. What that means for the other currencies, particularly in Q4 and early 23. So I might take that, separately for each of the currencies. Well, for the Japanese yen, so I think it is important to consider that the higher US yields, of course, created a lot of pressure on the yen. Now, if we do consider that yields would likely top out later on in the fourth quarter or the first half of this first quarter, it does mean that the pressure on the yen from the differentials of the US and the Japanese yields might ease. And of course, the intervention that they did in September has, of course, already played out quite well. I think they haven't seen USD yen break above 145, and it did go a little bit above 145 this week, but we haven't seen it cross that level. And again, that is a reflection of the lower US yields that we are seeing and the weaker US dollar that we're seeing in the last few days. Potentially, we will see another turn higher in the US yields again, and in the US dollar as well. But I think the intervention threat has become much bigger now from the Japanese yen, having seen it once, and I think that will play on the minds. And right now, I think a lot of traders, investors are positioning to prepare for that peak Fed hawkishness. And that will mean you have to drive the speculators out of that short yen positioning as well. So I think that's for the yen. For the sterling, I would say it has made a strong recovery after that tax cut announcement was rolled back. But at the same time, I think there's little confidence in this new government, and especially at a time when you are seeing that recession is coming, you are seeing double-digit inflation in the UK economy, and the energy crisis obviously is likely to get worse from here as well. So that does mean that when you have this unstable or a government or an administration that you can't rely on, that does mean that the assets will be weighed down. I think again the recovery in the sterling is more because of the fact that we are seeing a rollover in the dollar right now, which we don't think is going to sustain. We have to see another peak before we roll back down. So we do see some more pressure potentially in the euro dollar as well as the sterling dollar because of the energy crisis playing out there. I'll switch to the next one, which is on bonds. Redmond, do you want to take that question?
Yeah, sure. Yeah, I think the question asking, speaking of high yield, do we actually mean junk bonds, or is that correct? Yes, I mean high yield, we are referring to junk bond and non-investment grade. And we also spoke about high grade. When we say high grade, we are referring to the investment grade bond. And yeah, I mean, we are pretty much referring more on the US dollar, but basically in euro probably is still in a slightly later cycle. So maybe euro we probably can wait a little bit more, but overall the trend is the same, and we are expecting both the US Central Bank and Europe and the ECB actually is close to the most hawkish point, and so bond actually giving now positive, actually quite high real yield now, and relatively to its recent history, and so that become attractive. And one thing on just one note on the high yield, and I also mentioned about at the moment we prefer to stay with US, stay in the government or other high grade or investment grade bond, and we don't want to go down to the credit curve, and we don't want to go to the high yield or non-investment grade for the time being. Number one, the spread is we think they have not gone wide enough to embed to represent the risk. And I think just credit spread, and for the high yield especially, basically affect is one thing we are expecting the Fed or the other central bank is going to break something in the process of their peak hawkishness, including the economy. When the economy is not doing well, of course, it hurt corporate balance sheet and cash flow, especially cash flow, and also the volatility in the bond market also will hurt bank balance sheet on the equity ratio. So that is so that actually is hurting the balance sheet, hurting cash flow, especially in the high yield sector, and that is of course is not good for spread, so we stay away. The second thing is, I think you probably recall, when you price a corporate bond, high yield bond, the spread basically it represent sort of partly quite affected by the implied volatility or the put option on that company. So that means it's when volatility going up, the implied and the put options on the premium will be higher, i.e. there is wider spread in corporate bond. So that is you want to wait until the spread become wider before to get into high yield. And so at the moment we think that is to tiptoe in the bond market is more like an interest rate story. So that is stick with the duration risk. That means i.e. is invested in a high grade bond, and to take is really invested in the risk-free rate or interest rate. But for credit spread, for going to the high yield junk bond, and we have to wait until I think it's really we see some kind of really that something was already broken and it spread very wide, and all the crisis in some credit event, and those happen, and there will be opportunity that will be coming later, and not maybe early next year.
Great. Okay. I think there's one question on the RBA's action from yesterday. Jessica, it's for you, I guess.
Thanks, Charu. Great question, Greg. So Greg has asked, not sure if everyone can see the questions, but Greg said, do you think less aggressive increases in interest rates from the Central Bank of Australia yesterday shows a pivot from central bankers? So just starting on kind of what Redmond started out from the outset and combining it with what we took away from the RBA yesterday, and that is one key thing, that is consumer discretionary spending and household spending is likely to fall. So the RBA put this in black and white yesterday and said that spending is being stretched. So household budgets are stretched, and that is because of inflation, number one, and number two, interest rates. And as such, we've seen consumer confidence and secondly, house prices fall. We saw this in the US and we saw this in Australia as well. And with basic economics, the wealth effect, when property prices fall, people feel less wealthy, they're less likely to spend. So therefore, adding that in plus central bankers, including the RBA, specifically the RBA, allude to unemployment rising, as in employment falling next year. So Australia, very different to the US, very different to Europe, where they're paying record prices for gas. The Australian CPI, yes, that is running higher and is likely to pick up later this year, but the RBA pivoting to a dovish stance is purely because of the employment situation likely to deteriorate next year and inflation likely to die off. The RBA's thinking that, though, is that inflation will potentially fall from February next year. If you think about what is driving inflation, the biggest push of inflation is energy prices. And one of those key measures is the coal price. So the coal price in Australia, we know, usually peaks, regardless of Australia, the coal price usually peaks with peak demand coming from China and India in December, January. So could the inflation measure, CPI, roll over in January, February, and will other central bankers follow? I don't know. I'll let Charu take that one. But I think absolutely, we published on our note yesterday in our market insight that this is a clear line in the sand that peak hawkishness is now behind us, is now behind the RBA, because they've made their first, I guess, dovish hike. So hiking by 0.25%, which was far less than expected. But I hope that answers your question. I'll go back to Charu and she'll give her interpretation of what it means for the bigger bank, the beast that is the Fed.
I think, yeah, great insights there. But, I think it's also a point that this is not a point of pivot yet. Like I said, I mean, if you look at US, inflation is still running at about 8-9%, and rates haven't closed out to the 4.6% terminal rate that they gave in the dot plot last year, and we are actually not even pricing that in fully. So I do think that for Australia it may be a slightly different case, and more so because the Reserve Bank of Australia has a chance of meeting every month. So even with the 25 basis points rate hike every month, they can get a lot more done compared to some of the other central banks, which meet less often. So, I mean, for Fed specifically, I think they have to slightly stay more aggressive. And if we see this relief rally extending a lot further, they will have to kind of double down on their aggressiveness the way they did at the Jackson Hole, the way they did after the July to August rally that we saw. Because if financial conditions ease, the task to get inflation under control gets that much more tougher for the Fed. So while we do see that peak Fed hawkishness into the fourth quarter, I don't think we're there yet in terms of global central banks. But let's go on to the next ones. Jessica, do you want to take the one on gold? Gold has been stuck in a range, and when do you think it will break out?
So that's a really good question. I guess we should probably reference in All's research, and he basically speaks about the relationship, and Redmond would be able to speak about this as well, of course. I mean, we all can, but there's been a real relationship with higher yields pushing down the price of gold. And so we know that two of these very different asset classes have been seen as a safe haven. However, it's really critical to point out that although the US gold price has been lackluster, it's really critical to point out that the gold price in Australia is actually near its record. So the gold price today in Australia is at $2,650. So we've got a government in Australia that's more dovish than the Fed. So that is supporting the gold price in Australia up. We also have conditions, so financial conditions getting a lot easier for corporate Australia, and that is making it a lot more profitable for the corporate gold companies as well. So I guess if you were anticipating a move on the back of this, you would think that Australian gold mining companies would potentially likely see really cracking results, likely when they report their next results, and that is, of course, in February. So that's something to keep in mind. It is also worthwhile, of course, on the platform you can trade the underlying instrument. I do check out the Australian gold as well. But do either of you guys want to speak about the gold price in US dollars?
Yeah, sure. So I think gold has been battling this yield versus inflation for quite some time. And of course, so far, it is, I think, worth noting that despite the kind of gains that we've seen in the US dollar in real yields as well, gold has not really crashed. I mean, with 4% kind of yields, gold should have been much lower, no? But having been stuck in a broad range does signal that, I think it's potentially waiting for one of those two factors to kind of give way to the other. And if you kind of, agree with or believe in that view that we've shared in this call today, where we do think that potentially Q4, early Q1 would be the time when US yields top out. Well, that is a time when, the inflation, we don't think inflation is going to come back to the 2% levels that the Fed has been hoping for. So inflation persistently stays higher, but the yields top out. And that's when the inflation hedge, the safe haven gold, shines brighter, right? And so I mean, we still think that there's a lot of potential in gold, especially also priced in US dollars, especially when we see that turn of US dollar US yields getting back lower. So I think that's it on gold for me. We also have a question on traditional risk of currency. Yen has been performing badly, mainly because of the interest rate differentials going forward. Which currency asset would be the risk off set after the US dollar? Well, I think after the US dollar, it will be risk on. You wouldn't really need a risk off at that point in time. But we're not at that stage. And when things turn again as well, it is not going to be risk on so soon, not until the Fed clearly signals easing, which we don't think is happening in 2023 either. So I think potentially a little bit of sideway movement, sideway to down, sideway to up. But I think, that will be that will be the way to go for 2023. The Japanese yen has obviously not been as favorable, but like I said, once this yield differential pressure comes off, it could potentially return to be the safe haven. I don't know, but the Swiss franc is, of course, of note as well. I think having been short in the markets for quite some time, I think it'll also potentially, be the turn of events that happens this quarter, early next quarter again, which does bring out some new winners potentially. there's a question on oil as well. What are your thoughts about oil, considering how the OPEC Plus is looking to reduce production? Who would want to go on that?
I think we touched on that a little earlier. So, Charu, maybe you can pick up from here, but if I can just say two comments first. I think what we were highlighting from the outset was it's really quite poignant to point out that OPEC sees demand being greater than supply next year. So that's one thing to keep in mind. So the thinking is supply demand, that would potentially mean a higher price. But as always, we've got to look at what we're dealing with right here, right now. So the oil price has moved up markedly, rising for 2 straight sessions on the back of what we alluded to and what you've rightly questioned, potential OPEC plus cuts. So potential $2 million in production being taken out per day. If that does eventuate, as we were saying, that'll be the biggest production cut we've seen since COVID-19. So I think what would really be needed is for demand to pick up. So we do see, as we put in our quarterly, we do see absolute upside. We do potentially see more upside in the underlying instrument and indeed stocks in that sector. But I guess there's a lot hanging in the sales, and I think Charu can speak about that with the next couple of events that we're waiting for.
Yeah, sure. I think, in terms of course, the oil, we've always, since November, we've commented on those structural trends where we see supply being short, even with the kind of demand destruction that will likely happen with these higher interest rates. We don't think the market is going to come back in balance. So supply will remain short of demand, as Jessica had highlighted when she was talking about the equity baskets as well. And that does support a better oil picture from where we've been in the last few weeks. I mean, we've made a solid recovery in oil because of this expectation around cuts from OPEC Plus. Potentially difficult to achieve because most of the OPEC Plus members are producing below their quota already. But whether we get that or not, there are still supply constraints coming from US kind of pausing its releases from the strategic reserves. We have the sanctions from EU kicking in December as well. Embargo on Russian oil. So I think there are potentially some more supply issues to consider in the short run as well as in the long run because of the massive underinvestment in the oil and gas sector that we've seen over the last several years. So we don't have enough supply of oil and gas potentially. So I think, I think for oil, I would say that the bottom is probably closer than you would think. So I think it does look like it's poised for some upside from here. Another question is on the REITs sector. What do you think about Saxo's view on the REITs for next year? So for next year, I mean, if you again consider that rates will remain higher for longer, that does mean a bit of a problem for REITs. But again, with inflation still being the bigger problem, at hand, I think with REITs being able to give you that dividend yield, which can offset inflation, I do think that REITs with manageable debt loads, REITs with property exposure, probably not in China, but elsewhere where the property sector is holding up, I think could still be some favorable investments there. And I mean, I think it's 1 o'clock, so maybe it's just time to stop there. If you have more questions, feel free to reach out to your sales representatives who can also pass on the questions to us if needed. But I think stay safe out there. Winter is coming, and please continue to use the research tab on the Saxo platform for more insights into the markets and to understand how to navigate, how to position yourself in this very challenging environment. And on behalf of the team, thank you for attending today, and we hope to see you again real soon.
Thank you.